In this video, we're going to talk about what supply and demand are, how to use them in your trading strategy, and what are the advantages of why you should use them in your trading strategy. And last but not least, I'm going to give you one of my favorite strategies you can combine with the supply and demand. So, what are the advantages of using supply and demand? They provide low risk entry, minimizing losses, and provide high reward, maximizing profits. The zones provide high probability for buying at wholesale, which is an institutional level, and selling at retail to novice traders. By trading supply and demand, you're establishing the foundation for a simple rule-based strategy you can apply over and over. By doing this, you're preventing blind trading. Identifying supply and demand zones are essential for traders to know when market shifts from balanced to imbalanced states. Now, we're going to talk about balanced to imbalanced states. It is very crucial that you do recognize these zones as they put you in the right direction to position into the best trade setups just before they make the largest moves. Supply and demand represent a huge imbalance between buy orders and sell orders at a specific price range. When there is imbalance between supply and demand, it can cause the price to move in a certain direction. This is when we get the high-speed candles often are all the same color and show clear, powerful, and persistent dominance within the trend. This is because smart money is behind the move and they're pumping the prices or they're dumping the prices in a certain direction. For example, if there is a large excess of supply or sellers and not enough demand or buyers at a certain price level, it will cause the price to decline. Conversely, if there is a large excess of demand, buyers, and not enough supply, sellers at a certain price level, it will cause the price to rally. And this is what supply and demand is. There are two phases in supply and demand. We have balance and imbalance. You're going to see balance and imbalance in every single price chart that you look at. Anytime that you see a movement in the market, this is because supply exceeds demand or demand exceeds supply. So let's go over the two phases in supply and demand. First phase is price balance. Price balance is defined when supply and demand forces are equal. Price balance is when there is a consolidation zone, a calm yet controlled limited up and down range with low volatility movement in price action. Range bound, flat market, choppy, all of these terminologies describe price action to be flat and in a limited up and down range as it digests the prior large move. The reason why the price is in a consolidation is because majority of times you will see a large prior move that happened and price is trying to digest that move. And once price does digest that move, we should see another massive imbalance move. We're going to look at an illustration that will give you a clear understanding of what these two phases of supply and demand are. The market enters the balanced state, consolidating for price to cool off after the recent large move. Neither buyers or sellers are in control during the balanced range. Keep in mind, after every balance, price is then followed by a large directional imbalance wave. These two phases make up the cycles of market trend shifting from flat market conditions to major directional moves. In supply and demand strategies, we're going to study these areas of balance and imbalance to find high quality trade setups. So, here is the price balance and here is a price imbalance illustration. When price is in a balanced range, we will see that consolidation zone take place. And during that consolidation zone, there are traders exchanging hands with new traders. We can expect price action to be flat inside of the range, going up and down, ping-ponging up and down until eventually there is a breakout in either way, and the breakout is what provides the massive candles, which is the directional move. When price is in that consolidation base, the candles will be very small and controlled. However, as soon as there is a breakout within that zone, we will see a massive imbalance move. The imbalance is what provides the high probability trades. There are four types of supply and demand. Here is a formula for all of the four. And keep in mind, what you're always going to see is massive candles. The massive and powerful candles signify imbalance. After every imbalance, price will begin to consolidate, creating a range, which is the balance. Let's take a look at these four formulas of supply and demand. The first one is known as a rally base rally. This is a clear bullish characteristic and will take place in uptrending markets. The second one is a drop base drop. Drop base drop is a bearish characteristic and only found in downtrending markets. Anytime you see a massive imbalance move with several red candles, several red powerful candles that clearly stands out, this tells you that smart money is involved. And if smart money is involved, you as the little fish want to swim with the smart money. So, how do you take advantage of the large move that took place? You wait for the consolidation to take place, and once price breaks below the zone or above the zone, that's when you enter the trade. So you have two continuation types and two reversals. We're going to look at the reversals later on, but for now, I don't want to overwhelm you with too much information. I just want you to understand and recognize these formulas for now. We're going to discuss more in the next video. This back and forth trading inside of the consolidation range is repeated until eventually price action breaks outside of the range, triggering an imbalance move. So not only can you play the breakout of the supply and demand zones, you can also trade the wide range of supply and demand zones when price is consolidating inside of the base, inside of the zone. So how do you do this? How you do this is you're going to buy at demand and you're going to sell at supply. So you're going to be long at the demand zone with a stop loss slightly below the zone with your profit target at the supply zone. When you're shorting at the supply zone or when you're selling at the supply zone, you're going to have your target at the next demand zone lower. And your stop loss for the short entry is going to be just above the supply zone. So when price action does break above the supply zone, you're no longer in the trade, your stop loss will hit, the setup is no longer in play. This is because when the supply zone is broken, it tells us that demand is over exceeding sellers at that supply zone and the supply zone is no longer strong or no longer tradable. So same goes with demand. If you're going to enter at the demand zone and price goes below the demand zone, you should no longer be in the trade because the zone is no longer intact as supply over exceeded demand at the demand zone. So again, to trade inside of the base, you're going to buy long at the demand zone and you're going to sell at the supply zone. You're going to take profits at the supply zone. If you go short at supply zone, you're going to exit at the demand zone. If you enter at the demand zone and price goes below the demand zone, you should no longer be in the trade as the demand zone is no longer intact. Same with the supply zone. If you enter the trade at the supply zone and price action breaks above the supply zone, your trade is no longer intact and you should no longer be in the trade. If you have one contract, you will have one profit target level to exit. However, if you have more than one contract or more than one position, you will have more than one profit target. So last but not least, we talked about one of my favorite strategies to combine with supply and demand zones. So when identifying supply and demand, it is important to consider the overall trend of the market. If the market is in an uptrend, you want to look for demand areas or support to enter long positions. If the market is in a downtrend, you as a trader want to look for areas of supply or resistance to enter short positions. This is because supply and demand zones will tell you where to buy and sell, right? So supply and demand will tell you exactly where in the location of the chart you're going to be a buyer and when you're going to be a seller. So here's why this is very important. The trend will tell you when to buy and sell. Here's what I mean. If price is in a downtrend, this is when you sell, right? This is when you become a seller. This is when you short. This is when you're bearish. When price is in an uptrend, this is when you're bullish, this is when you buy, this is when you're long. Supply and demand zones, on the other hand, will tell you exactly where within the chart, where within the price you're going to buy, and where within the chart you're going to sell. So let me put this into illustration. If the market is in a downtrend, you're going to be a seller. This is where you're going to draw your supply zones, and you're going to prioritize your supply zones over demand because you don't want to be a buyer when the trend is down. And when the trend is up, the market is in an uptrend, the price is in an uptrend, you're going to look for demand zones, and you're going to prioritize demand zones over supply because supply and demand zones tell us where to buy and sell, while the trend tells us when we should be bearish or bullish. Hopefully you all enjoyed this video. Thank you so much for watching, and I look forward to reading your comments as well as your suggestions for the upcoming videos. I hope this video helped you, traders. If you would like me to make more of these, more into depth on supply and demand zones, please like this video, subscribe to our channel so you get the notifications when we upload,